time is 6:45. I'd like to call this Town of Plainfield Pension Board meeting to order and go through roll call.
Art Gagny.
Kevin Cunningham.
Peggy Board.
I did hear from Dean, said he would not be able to make it. I have not heard from Christie, so. Item C is public comment. Anybody here from the public wish to speak on the items tonight? Okay.
So proud.
Item D is to approve the minutes of the pension board meeting dated 9/8/2025.
Make a motion to approve the meeting minutes for 9/8/25.
And I'll second it.
Any other discussion? All in favor say aye.
Aye.
Thank you. We do not have old business. For new business, there's just two items. The first item is to consider an act on the pension distributions as requested. I will remind you, though, we've been asked politely to add one more thing in for the motion when it's made as to what board they came from, like Board of Ed. So you have in front of you a request from a Cynthia Pelletier. She is from the Board of Education, occupational therapist. She is asking that she gets a pension distribution commencing on September 1st in the amount of $963.37. She has been with us for 20 years, so I want to thank her for her service.
So when this commences on September 1st, and this is October, do we back pay that?
Yes.
Okay, that's my question. Okay, thank you.
Yep.
I'll make a motion to approve the pension for Cynthia Pelletier of the BOE for $963.37 per month, starting 1 September 25.
And I'll second it.
Any other discussion? All in favor say aye.
Aye.
Thank you. So for the second part of, thank you. We should be doing this more often, but we did talk about at our last quarterly meeting that maybe it would be nice to have an understanding of what fiducian does for the town of Plainfield and our pension, so the quarterly investments, how they work. So if you wouldn't mind, you can.
Sure. Absolutely, and please feel free, I can do feel free to interrupt or send me in another direction if I'm not being clear, you want to talk about anything different.
So just one thing, this would have been nice to have ahead of time to look at before the meeting.
Okay, sure.
Just for information's sake.
Yep.
When we're going to do a meeting like this, it would be nice if we had this in advance so we could look it over rather than just going through it tonight.
Yep, makes sense.
Okay.
And that's typically the way that we operate when I have my quarterly meetings with Paul and the finance director. So in the future when we,
I mean, if you're going to
come
address
back.
the board of selectmen, if you could do that, I'd appreciate it.
Sure,
Thank you.
absolutely. So I thought I would take a couple minutes just to give you some background on the relationship between fiducian and the town and give you a sense of the firm as a whole before we get into this. So we first started working with the town in 2014, so just about 11 years together. I am a partner with fiducian. I've been with the firm since our inception. I've been in the investment industry for over 20 years. So I work with many other municipal plans, and across the firm we have 45 of the municipal plans in the state of Connecticut are clients. So for those plans we either service the pension, the OPEB, the defined contribution plan, or a combination of those three. But most commonly we work with the pension. In terms of other lines of business, fiducian has about $370 billion in assets under advisement or management. So that incorporates pension plans as well as defined contribution plans like corporate 401k plans or nonprofit 403b plans. We also have a lot of endowment foundation clients, some private wealth. So all of those different lines of business work together to bring us to that $370 billion. We have two primary offices. I work out of the Windsor, Connecticut office, and then our other primary office is in Chicago, and then we have a couple satellite offices as well. So very broad-based, large firm in terms of scope of services and clients that we reach. But again, within the state of Connecticut, we advise about 45 municipal plans. Any questions about the firm or the relationship? Okay. And typically the way that it has historically worked is I have met on a quarterly basis with the first selectman and the finance director. And I have said, happy to meet with the Board of Finance as frequently as you like. Different towns operate in different ways. Sometimes I'm dealing directly with the Board of Selectmen, sometimes I'm dealing with just a couple individuals, so certainly the relationship can be structured however the folks at the town want. So if you flip open to page 6, this is our fiduciary governance calendar. So this is one of the things that our clients tend to like and appreciate, that we create this disciplined framework around governance. So at the end of a calendar year, you can look back and you have this trail of documentation. Okay, we reviewed the investment policy statement. We looked at the municipal landscape and compared our plan to other plans. And, so it kind of helps the trustees feel confident that, you're meeting all of your responsibilities. So this quarter, we're reviewing the third quarter results. So this is an update on the municipal landscape. Page 7, this is part of every quarterly report where we just include the most recent actuarial snapshot. So you have the pension plan in the top table and then the OPEB beneath that. Both of these plans,
What is OPEB?
Other post-employment benefits.
Okay.
So both of these plans, the actuary runs a valuation report every other year. So the most recent val report for the pension was was based on the 2023 year end, and for the OPEB was the 2024. So the actuary will be working on one for 2025.
Question, in 2023, are we underfunded in pension?
Yes, technically.
How does that stand now?
I don't know because they haven't done the valuation report for 2025, but probably you have made a slight adjustment. But I will point out that at 94% funded, you are much better funded than most of your peers. So I'll show that in a couple slides. So even though the plan is not 100% funded, again, with the work that we do with other municipalities, I don't know of a single municipal plan that is 100% funded. Most are around 75%. So you can see that one of the most important things on this page is the actuarial return assumption of 6.5%. So I want you just to flag that in your mind, because that is the assumption that the actuary is using when they do the calculations of how much the town is going to have to contribute. They are expecting these assets to grow at a rate of 6.5%. So if you have asset growth in excess of that 6.5%, that means that the town will have to put in less money because the assets have grown more than expected. Vice versa, if we have a return of less than 6.5%, then the town will have to catch up on the contribution.
Are we close? And since you brought up other towns, are we 6.5%? Is that good, or is that compared to the other towns? Or
We'll show both of those things on the following pages. So if you flip ahead to page 8, this shows trends in investment return assumptions. So the average return assumption is 6.43%. So at 6.5%, you're right around the average. The median is 6.5%. So you're in very good company. What this graph, the bar chart, shows on the bottom left-hand side is the range of return assumptions. So you can see you would fall within the category of 6.5 to 6.74%. 28% of municipal plans in the state of Connecticut are using a return assumption that falls within that corridor.
What are the rest using?
You can see it right here. So about, let's see,
28%.
About 30% are below 6.5%, and then the remainder are above. So for instance, 25% of plans are using a return assumption of 6.75 to just about 7%. Does that make sense?
Yes.
Okay. So I would say the takeaway from these charts on this page is that over the last decade or so, return assumptions have shifted lower. But they've kind of plateaued over the last 3 years or so, where most plans seem to have gotten to a level where actuaries and investment consultants feel that, you know, a 6.5% return assumption is pretty justifiable, should be able to be achieved over time. Whereas you can see back in 2015, the average was over 7%. So to expect the plan's assets to return over 7% per year, that's a pretty hard bogey to beat. So it was natural that the progression would be, or that the trend would be downward. And you can also see that when we look at this bar chart and you look at the comparison between 2023, which is shown in the purple bars, to 2024 in the orange bars, the percentage of plans that are using a return assumption in excess of 7% has declined, and then there's been an uptick in, you know, that kind of mid-range between 6 and 6.75 or so. And then on page 9, we show the return assumptions by plan size. So at 38 million, your plan falls in that second category. And in 2024, the average investment return assumption for plans of your cohort was 6.54%. So again, at 6.5%, you're, you know, right in line with peers. You're not an outlier, which is good. And then the next couple pages show the funded status of plans, and as you can see, there was kind of a bump up in 2021 because of some very strong investment returns, but by and large, funded status has stayed about the same over the last approximately 10 years, and the average funded status was 74.3% for fiscal year 2024. Again, you were at 94.1%, so you are the most positive change on a year-over-year basis. So that's actually the strongest group at 80% funded, but still you are well in excess of that.
So question, I know you're saying 94% is a good number. Shouldn't we be striving for 100%?
Well, yes.
Just going, you know what I mean?
Yeah, but it's not going to happen overnight.
No, I
Yeah.
get that. I'm just saying, I know you're saying 94% is a good ratio compared to other towns, but you know, what other towns are doing is not what we need to be doing in Plainfield.
Right. 100% funded is the goal, and that's why
Do we have a plan to do that?
when you make the annual contribution, the actuary gives a recommendation of how much you should contribute to the plan, and yes, it's in order to get there immediately, you'd have to give a
Well, it would have to be a
contribution.
big bump, but I'm just saying.
Yes. Ultimately, if things move in the right direction and the town continues to contribute according to what the actuary says, and the assets continue to perform well, then yes, you should get to 100% funded. And then the last page is just about OPEB plans. Kind of by their nature, OPEB plans are not nearly as well funded as pension plans because they are much newer, and also for the most case, there are not payments that are being actively made. Whereas with the pension, you have monthly distributions that go out to pay the retirees. OPEB plans are, you know, it's kind of as needed funded or funding for recipients. So your return assumption for the OPEB is 6.5%, very just right in line with the pension, slightly above the median return assumption across the state of Connecticut for OPEBs, which is 6.25%, and your plan is 31.5% funded, which is slightly less funded than the average, but still, you know, you are in good company. And I don't recall exactly what I know that you have contributed to the OPEB in years past, but it's not necessarily a continuous
Do
contribution.
you have a plan for that, Kevin?
Like to. We'll be sitting
Yeah.
down and talking about that, where we get the money from.
Well, there should be an ongoing plan with some kind of,
Well, we do take advisement, have been working with our finance director on that, so we would like to continue that process, but we have to have someone as a finance director to work with.
we've had a finance director though, that's what I'm saying. I mean, I get that she's gone now, but this is 2024. These numbers that you're giving us are for 2023 and 2024 when we had a finance director, correct?
Mm-hmm.
Yeah, but it's something that I mean, it's not uncommon that funding the OPEB, it falls very low on the list. Again, there's generally not an immediate need for distributions from that plan. And when you have, road work that needs to be done or,
But pensions
in
and
a perfect
OPEBs
world.
Yeah, pensions and OPEBs are very important things too for the people that work for the town.
Yep. Okay, so that was the governance calendar. So I'll spend just a couple minutes talking about the broad capital markets. So on page 14, you can see some broad economic data. The market environment has actually been very strong so far this year. There has been quite a bit of volatility, but by and large, we're looking at very strong returns across the board. But we are starting to see some weakness in some economic data points. So for example, you can see some labor market statistics on the left-hand side of page 14, where the unemployment rate has ticked up and, workers have ticked downward. So we're starting to see a bit of stress within the labor market. The Fed did cut rates at their September meeting. The expectation is that we are likely to see another 1 to 2 rate cuts before the end of the year, probably another 25 basis points at each of their next 2 meetings. That should be, kind of wind in the sails of the broad economy. But by and large, those expected rate cuts are really already baked into markets. So what we don't really expect that to have a significantly positive impact, but if the Fed does decide not to cut rates at either of their next 2 meetings, that could have a negative impact on market results. One of the things that we've seen so far this year is significant outperformance of international equities, which is a shift in a trend that we had seen for the last 10, 15 years, where domestic markets had significantly outperformed. So on the bottom left of page 15, you can see points ahead of US markets on a year-to-date basis, and emerging markets are about 13% or so ahead. So having diversification and exposure to international equities has been a real tailwind so far this year. And then one of the other dynamics that we've seen is it's really been large cap domestic equities that have driven markets in recent history, and we've started to see that shift just over the past couple months or so, because small cap companies are more heavily reliant on debt. So with the Fed beginning their rate cut campaign, that's going to be wind in the sails of small companies, because they have more debt. As the cost of servicing that debt comes down, that's better for small cap companies. So you can see the leverage levels within small cap are much higher within large cap. So again, that falling interest rate environment is likely to be more positive for small caps. So we could see kind of a rebound in small cap companies. Our exposure to, or the town portfolio's exposure to small caps has been not detrimental, it hasn't been negative, but it has been kind of a headwind relative to large cap. So we are likely to see that shift. So on page 16, you can see these are the market results so far this year. So it's for the first 9 months of the calendar year. And we're looking at positive results across the board. All of the fixed income segments of the market are shown in the navy blue bars. The equity exposure is shown in the gray bars, and then kind of everything else like real assets and commodities and hedge funds is shown in royal blue. So what you can see is that every area of the investable universe for the most part has been positive. You can kind of ignore the circles, those represent the third quarter results, but the bar represents the year-to-date results. And again, the biggest visual takeaway from this page is the significant outperformance of international markets, both developed markets and emerging. So a broadly diversified portfolio has performed very well so far this year. And if you think about, long-term expectations of returns, the expectation is for bonds to return somewhere around 4% long-term, and stocks to return about 7% so far, or 7% over the long run. And these results have been well in excess of that so far this year. And then if we can just flip ahead a few pages to page 20, This is a page that I always like to highlight, and it just shows the importance of diversification. So it can be easy for folks to look at what has happened very recently and say, oh, well, why would we have any exposure to asset class ABC? You know, it hasn't performed well, let's put all of our money in asset class, you know, DEF. What this shows you is over the last 10 calendar years, we have the best performing asset class at the top of each column, going all the way down to the worst performing asset class of that calendar year. And the big takeaway from this chart is that there's really no rhyme or reason. So it's very hard to discern by looking at what worked last year and what didn't work last year, what's going to work next year. But what is discernible is that a balanced portfolio, which is shown in the orange box, it's never at the top, but it's also never at the bottom. So it has that smooth return stream in the middle. So by having diversification,
of something we should move or something we should do as far as, I know 2025 is almost over, but I'm talking about 2026.
no, that's something that we are, so the way that we work with the town is we have what's called a discretionary relationship where we have been given authority to make portfolio changes and then report out. So we are always, if we think that there's a change that needs to be made, we're always doing that.
And then you report to the
Yes,
selectmen?
yes, yep.
When there's an issue that they see something trending downwards, they also notify us saying we're concerned about an area, so they monitor that for us as well.
Okay.
Right.
So
Yep.
there's a constant monitoring of the
Yes,
situation.
and your portfolio is always very well diversified. It has exposure to all of the appropriate asset classes. Okay, any questions about the broad capital markets? All right. So I'll just take a couple minutes to talk about the portfolio performance. So if we look on page 23, here's a snapshot of the pension plan. So we do show the returns of the plan on the top left-hand side. You can see the bar chart. So on a calendar year-to-date basis, I mentioned that markets have been very strong. The portfolio is up 12.7% so far this calendar year. And again, thinking about those long-term return expectations of about 4% for bonds, about 7% for stocks, you would expect maybe, 6.5% return or so. You've already earned 12.7 so far this year. And then if you look at the annualized results over the past 3 years, the annualized return of the plan has been 16.1% per year. Over the past 5 years, 9.5%, so on and so forth. So if we think back to that 6.5% return target, your plan has exceeded that return target across all timeframes. So you are growing the plan's assets at a faster pace than what the actuary would have expected. So that's very good for the town, and it means that the contribution is lower. If we take a look at the top right-hand side, you can see the growth of assets. So we ended the third quarter with just over 38 million in the pension plan. And then I think it's interesting to go back to the since inception column and look at the growth of the plan. So the beginning market value back in 2014 was 17 million. Since that time, you've had net outflows of 701,000. I will tell you, compared to other pension plans, these net flows are incredibly strong. Most plans we see net outflows because the monthly pension payments for most municipalities are higher than what the plan is putting in. So this shows that the outflows and the town's contributions over the past 11 years have almost canceled each other out.
So that's good. Each other out.
Yep.
Okay.
And then you've had asset gains of about 21.7 million to bring you to that ending value of 38 million. So this represents very strong growth. And then in terms of the asset allocation profile, you can see that in the bottom half of the page. So our overall target is 30% to fixed income, 39% to domestic equity, 23.5% to international equity, and then we have 7.5% to real assets. So again, very broad diversification. We run asset allocation studies on an annual basis, which there's a lot that goes into them, but we update our capital market expectations, and we will run the portfolio's allocation profile and say, okay, over the next full market cycle, it's our expectation that the plan will return on average X% per year. And what we try to do is make sure that the plan is always appropriately positioned to help.
Of something we should move or something we should do as far as, I know 2025 is almost over, but I'm talking about 2026.
No, that's something that we are, the way that we work with the town is we have what's called a discretionary relationship where we have been given authority to make portfolio changes and then report out. So we are always, if we think that there's a change that needs to be made, we're always doing that.
And then you report to the
Yes,
selectmen?
yes, yep.
When there's an issue that they see something trending downwards, they also notify us saying we're concerned about an area, so they monitor that for us as well.
Okay.
Right.
So
Yep.
there's a constant monitoring of the
Yes,
situation.
and your portfolio is always very well diversified. It has exposure to all of the appropriate asset classes. Okay, any questions about the broad capital markets? All right. So I'll just take a couple minutes to talk about the portfolio performance. So if we look on page 23, here's a snapshot of the pension plan. So we do show the returns of the plan on the top left-hand side. You can see the bar chart. So on a calendar year-to-date basis, I mentioned that markets have been very strong. The portfolio is up 12.7% so far this calendar year. And again, thinking about those long-term return expectations of about 4% for bonds, about 7% for stocks, you would expect maybe, 6.5% return or so. You've already earned 12.7 so far this year. And then if you look at the annualized results over the past 3 years, the annualized return of the plan has been 16.1% per year. Over the past 5 years, 9.5%, so on and so forth. So if we think back to that 6.5% return target, your plan has exceeded that return target across all timeframes. So you are growing the plan's assets at a faster pace than what the actuary would have expected. So that's very good for the town, and it means that the contribution is lower. If we take a look at the top right-hand side, you can see the growth of assets. So we ended the third quarter with just over 38 million in the pension plan. And then I think it's interesting to go back to the since inception column and look at the growth of the plan. So the beginning market value back in 2014 was 17 million. Since that time, you've had net outflows of 701,000. I will tell you, compared to other pension plans, these net flows are incredibly strong. Most plans we see net outflows because the monthly pension payments for most municipalities are higher than what the plan is putting in. So this shows that the outflows and the town's contributions over the past 11 years have almost canceled each other out.
So that's good.
Yep.
Okay.
And then you've had asset gains of about 21.7 million to bring you to that ending value of 38 million. So this represents very strong growth. And then in terms of the asset allocation profile, you can see that in the bottom half of the page. So our overall target is 30% to fixed income, 39% to domestic equity, 23.5% to international equity, and then we have 7.5% to real assets. So again, very broad diversification. We run asset allocation studies on an annual basis, which there's a lot that goes into them, but we update our capital market expectations, and we will run the portfolio's allocation profile and say, okay, over the next full market cycle, it's our expectation that the plan will return on average X% per year. And what we try to do is make sure that the plan is always appropriately positioned to help. And then I'll just mention on page 24, this again shows the allocation profile. But the other thing that you can see on this page is on the far right-hand side of the table, you can see the minimum allocation and the maximum allocation to each asset class. That is captured within the investment policy statement, and this is something that we always monitor. So we make sure that the plan's allocation is within the guidelines that have been established within the investment policy statement. And then finally on page 25, we've talked a lot about diversification. Here you can see all of the underlying holdings within the plan. At Fiducian, we don't invest in any individual stocks or bonds directly. We're not choosing, okay, we think you should invest in Netflix or Google, or we are doing research on institutional money managers. You can see that everything in your portfolio is accessed through a mutual fund vehicle. And so we've got, again, very broad diversification even within all of the asset classes. So for instance, within fixed income, we've got 5 underlying managers. 2 of them are kind of traditional fixed income managers that are similar to the Barclays Aggregate Index. And then the others are more diversifying exposures to help create overall, kind of a